On August 5th, a British asset manager listed a new fund on the London Stock Exchange. The announcement was technical, the language was financial, but inside that fund sits the debt of African governments, gathered into a single product, priced in dollars, and tradable in one click by any investor in Europe. No version of this product currently trades on any African exchange. The marketplace for Africa's sovereign debt has just acquired a powerful new address. And that address is not in Accra, not in Nairobi, not in Lagos. It is in London. What makes this launch significant is not the financial engineering itself. Investors have traded African bonds for decades. The change is structural. For the first time, African government debt has been bundled into an exchange-traded fund listed in Europe, seeded with capital from the British government's Foreign, Commonwealth and Development Office. This is the first ETF the British Foreign Office has ever directly invested in. The choice of product is a statement of intent, whether the architects say it aloud or not. This video examines what that statement means. It places the London ETF alongside another development that surfaced the same week, the renewed push for the eco-currency in West Africa, Guinea's decision to opt out, and the unresolved question of what will actually anchor that currency. Taken separately, these are financial and monetary stories. Placed side by side, they reveal a pattern. The architecture of African financial sovereignty is being shaped. The question is, who holds the pen? If you follow African geopolitical shifts, subscribe to the Sahel Lens for evidence-based documentary analysis. The fund launched by Legal and General Investment Management holds bonds issued by African governments. Every single one is denominated in United States dollars. This is not a minor detail. Dollar-denominated debt means the borrowing government earns revenue in its local currency, but must repay in dollars. When the local currency weakens against the dollar, the real burden of that debt rises. The risk sits entirely with the borrowing nation. The investor in London or Frankfurt carries no currency exposure beyond the credit risk of the sovereign issuer. The official logic behind this ETF is not baseless. The project originated from the Liquidity and Sustainability Facility, an initiative launched in 2021 under the United Nations Economic Commission for Africa, chaired at the time by Cameroonian economist Vera Songwe. The LSFF's stated mission is to solve a genuine problem. African sovereign bonds suffer from low liquidity in secondary markets. When a buyer cannot easily resell a bond, they demand a higher interest rate to compensate for that lock-in. Finance ministers across the continent call this the African premium. It means Ghana or Kenya or Zambia pays more to borrow than countries with comparable or even weaker economic fundamentals. Over the life of a billion-dollar bond, a single extra percentage point costs $10 million every year. That money does not build roads. It does not fund hospitals. It goes to investors as a liquidity penalty. The LSFF's argument is that bundling African bonds into an ETF will attract new buyers, deepen secondary market trading, reduce the liquidity premium, and eventually lower borrowing costs for African treasuries. The mechanism is not theoretical. Similar structures have worked in other emerging markets. If it functions as designed, the fund could return real savings to African governments. But a mechanism is never just a mechanism. It operates inside a power structure. And that structure demands scrutiny. The debt in this ETF is denominated in dollars. The fund is domiciled in London, regulated by British authorities, and traded on a European exchange. African institutional investors, pension funds, and central banks can theoretically buy shares in it. But they do so on a platform they do not control, under rules they did not write, in a currency they do not issue. The daily price discovery for African sovereign credit now has a loud new microphone, and that microphone sits in the City of London. Consider what happens during a panic. A European central bank rate decision, a geopolitical shock in another region, a sudden shift in investor sentiment. Capital rushes out of the ETF. That selling pressure flows downward into the underlying bonds, pushing their prices lower, raising their yields. Weeks later, an African finance minister approaches the market to refinance maturing debt and discovers that the price of his country's bonds has moved. Not because anything changed in his economy, not because of a coup, or a drought, or a policy failure, but because of a mood that originated 6,000 kilometers away. In good times, the ETF could make African borrowing cheaper. In bad times, it could transmit external shocks faster and deeper than before. Either way, the daily judgment of what African sovereign debt is worth has gained a new center of gravity. That center is in Europe. This brings us to the comparison that makes the London launch difficult to defend as a purely developmental exercise. Africa already built a version of this product. In 2018, the African Development Bank, in partnership with the MCB Group of Mauritius, launched the African Domestic Bond Fund. It holds African government bonds denominated in local African currencies, not dollars. It is listed on the Stock Exchange of Mauritius, with a secondary listing in Botswana. The AFDB committed $25 million as anchor investor. The stated purpose was precisely what the continent needed: reduce dependence on foreign currency debt, grow domestic bond markets, and advance African financial integration. 8 years later, the ADBF remains tiny. The entire fund holds approximately $46 million in assets. It did not attract the British government as a seed investor. It did not attract a giant asset manager as a sponsor. It did not generate celebration in the international financial press. The money and the noise only arrived when the product was rebuilt in London, in dollars, under European rules, for European investors. This disparity is not a footnote. It is the core of the story. The global financial system signals its priorities through capital allocation. A fund built by Africans, in African currencies, on an African exchange, for African financial integration, was starved of attention and scale. A fund built in London, in dollars, accessible to European investors, received government backing, institutional sponsorship, and immediate market validation. The conclusion is uncomfortable, but unavoidable. The system rewards structures that maintain the centrality of Western financial hubs. It neglects structures that build autonomous African capacity. Now widen the lens. The same week the London ETF launched, another financial story was unfolding in West Africa. On July 19th, ECOWAS heads of state reaffirmed that the eco-currency would launch in 2027, beginning in phases. This is the latest in a series of deadlines stretching back more than 2 decades. Within days, Guinea became the first member state to formally opt out of the planned launch. Guinea will retain its own franc, a currency it has controlled for over 66 years, rather than adopt a new regional currency whose foundational rules are still being negotiated. Guinea's decision exposes a fault line that the celebratory communiques cannot paper over. 5 of the 12 ECOWAS member states currently use the CFA franc, a currency created by France in 1945 during the colonial era and still pegged to the euro with a French treasury guarantee. 3 other CFA users, Mali, Burkina Faso, and Niger, have already left ECOWAS to form the Alliance of Sahel States, and have indicated they will not participate in the ECO project. The December 2026 ECOWAS summit is supposed to finalize the central bank structure, the decision-making rules, and the list of participating countries. One fundamental question remains unanswered. What will anchor the ECO? Will it be pegged to the euro, maintaining the structural link to Paris that the CFA franc embodies? Will it float? Will it be backed by a basket of reserves? Until that question is settled, the ECO remains a political declaration dressed in monetary language. In December 2019, President Emmanuel Macron and President Alassane Ouattara of Côte d'Ivoire attempted to rename the CFA franc as the ECO while preserving the euro peg. The move effectively hijacked the name of a Pan-African project to preserve a French-guaranteed currency arrangement. That history has not been forgotten. Place the London ETF and the eco-currency push side by side. On one side, African sovereign debt is being repackaged into a dollar-denominated, London-listed product. On the other, West Africa is being pushed toward a single currency whose anchor remains undecided, with the CFA franc countries at the center and the shadow of the French treasury still visible. Debt and currency, the 2 fundamental pillars of economic sovereignty. Both are in motion. Neither is being shaped primarily by African institutions, operating on African soil under African rules. The larger geopolitical context gives this pattern coherence. In February 2026, at the Munich Security Conference, United States Secretary of State Marco Rubio delivered a speech that European allies received with what was described as enthusiasm. He spoke with open nostalgia about the legacy of Western empires. He told European nations they should not be shackled by guilt over colonial history. He explicitly tied Western security to supply chains and critical minerals. European Commission President Ursula von der Leyen responded publicly that she was reassured by the speech and listed raw materials among the areas Europe must now secure. The minerals in question, cobalt, lithium, rare earth elements, sit under African soil. The speech was not about history, it was about the future of resource access. And the audience understood that. When a senior American official publicly releases European powers from historical accountability while simultaneously directing their attention toward African resources, and within months, a new financial instrument repackages African debt for European investors, and a regional currency project with unresolved sovereignty questions accelerates toward launch, the sequence deserves to be examined as a pattern rather than a series of coincidences. Power in the 21st century does not require gunboats. In the 1880s, European powers gathered in Berlin and partitioned a continent with lines on a map. In 2026, a fund is listed in London, a currency peg is preserved in Paris, and the daily price of African debt is set by traders who have never set foot on the continent. The mechanism is financial. The outcome is comparable. Control over what Africa earns, what Africa owes, and what Africa can decide. But the picture is not one-directional. During the same period, a smaller but structurally significant development took place that suggests an alternative path is technically feasible. On July 24th, the first offshore bond denominated in Tanzanian shillings was listed on the London Stock Exchange. The issuance totaled approximately 262 billion shillings, roughly $100 million. It carried a 5-year maturity at 7.6% interest. Tanzania's finance minister attended the listing in person and described it as the beginning of Tanzania's participation in international capital markets using its own currency. The bond was not issued directly by the Tanzanian government. It was issued by the International Finance Corporation, the private sector arm of the World Bank, which carries the highest possible credit rating. The IFC raised the capital in London and on-lent the proceeds in shillings to Tanzanian small and medium enterprises, with 20% earmarked for women-owned businesses. The World Bank estimated the facility could support up to 20,000 jobs. The structural innovation matters more than the scale. In a conventional African dollar bond, the borrowing country carries the currency risk. If the local currency depreciates, the real debt burden swells. The pain lands in Africa. In the Tanzanian structure, the debt is measured in shillings. The investor's return rises and falls with the shilling. If the currency weakens, the loss sits on the investor's side of the ledger. Meanwhile, the businesses borrowing the money earn their revenue in the same shillings they use to repay. The currency mismatch is removed at the source. Tanzania did not stop there. On August 6th, the same week the London ETF launched, the Bank of Tanzania opened its domestic government bond and treasury bill market to foreign investors of any nationality. Global capital is now welcome to enter Tanzania's own market, in Tanzania's own currency, under Tanzanian rules. Instead of sending its debt abroad to be repackaged into someone else's product, Tanzania pulled the market toward itself. The contrast is instructive. One model gathers African debt, wraps it in dollars, and packages it for convenient trading in Europe. The other model invites global capital into an African currency, on African terms, with the structural risk shared rather than exported. One deepens dependence on external financial architecture. The other builds domestic capacity. Neither model is perfect. The Tanzanian bond required the IFC's credit rating to function. A country with a lower sovereign rating cannot replicate it tomorrow. But the direction of travel is clear. This brings the analysis back to the central question. The LSFF's ETF may succeed in lowering African borrowing costs. That outcome would be materially beneficial. Every basis point saved on debt service is money that can fund development. The question is whether cheaper borrowing, achieved through an externally controlled mechanism, strengthens or weakens long-term sovereignty. The answer is not binary. It depends on what African governments and institutions do in parallel. If the ETF reduces costs, while African domestic bond markets continue to deepen, if African pension funds and central banks build their own pooled investment vehicles, if the African Domestic Bond Fund receives the capital and political backing it has been denied for 8 years, then the London ETF becomes a useful complement, not a structural threat. But if cheaper borrowing through London becomes the primary channel while African market infrastructure remains underdeveloped, the dependence deepens. And dependence, once embedded in the architecture of debt pricing, is difficult to reverse. The same logic applies to the ECO. A single West African currency could theoretically reduce transaction costs, eliminate exchange rate volatility within the region, and support the African continental free trade area. But the benefits depend entirely on the governance structure. A currency whose anchor is determined by the needs of the Eurozone, whose reserves are held in Paris, and whose monetary policy is constrained by a peg designed in a previous century, will not deliver sovereignty. It will deliver a renamed CFA franc. Guinea understood this. The AES states understood this. The December summit will reveal whether the remaining ECOWAS members understand it too. The African Continental Free Trade Area remains the most significant structural response to these external pressures. A unified market of 1.4 billion people, with combined GDP exceeding $3 trillion, changes the calculus. It makes intra-African trade the driver of growth. It reduces the continent's vulnerability to external financial shocks. It creates the scale needed for African exchanges, African payment systems, and African investment funds to compete. But the AFCFTA is operational on paper, not yet in substance. The payment infrastructure, the customs harmonization, the rules of origin, the dispute resolution mechanisms, all remain works in progress. Europe is not waiting for Africa to finish building its house. The ETF launched this week. The ECO deadline is next year. What would a serious African response look like? It would begin with capital. African pension funds collectively manage hundreds of billions of dollars in assets. A fraction of that capital, directed into a properly structured African sovereign bond fund listed on African exchanges, would change the scale of domestic debt markets within a decade. It would require coordination between finance ministries, central banks, and pension regulators across multiple jurisdictions. It would require political will to overcome the inertia that has kept the ABF at $46 million, while the London ETF launched with government backing and institutional scale. The technical infrastructure exists. The 2018 fund proved the concept. What has been missing is not capacity, it is commitment. The pattern revealed this week is not a conspiracy. It is the predictable behavior of powers acting in their own interests. The British government seeded a fund that deepens London's role as a hub for African debt trading. The French Treasury continues to guarantee a currency arrangement that keeps 14 African countries structurally linked to Paris. The American Secretary of State publicly frames African minerals as a Western security imperative. Each actor is pursuing its own strategic objectives. The question for African policymakers is whether they will pursue theirs with equal clarity. The facts of this week are these. Legal & General launched the first ETF of its kind in Europe, holding exclusively African government bonds, all denominated in dollars, seeded by the British government's Foreign Office. The fund originated from an African-led initiative under the UN Economic Commission for Africa. No equivalent product trades on any African exchange. The African Development Bank's Domestic Bond Fund, launched in 2018 in African currencies on an African exchange, remains below $50 million in total assets. ECOWAS reaffirmed a phased eco-currency launch for 2027. Guinea opted out. The CFA franc remains pegged to the euro. The anchor for the eco is undecided. Marco Rubio at Munich praised Western empires and tied Western security to critical minerals. Tanzania listed an offshore shilling bond, and opened its domestic debt market to foreign investors in the same week. The analysis that follows from these facts is that financial sovereignty is being contested on multiple fronts simultaneously. Debt architecture, currency arrangements, and resource access are not separate stories. They are the same story viewed through different lenses. Africa does not yet control its own debt pricing, its own currency arrangements, or its own market infrastructure. Until it does, decisions made in London, Paris, and Washington will continue to shape outcomes in Accra, Bamako, and Ouagadougou. The cost of that dependence is measurable in basis points on bond yields, in the constraints on monetary policy, and in the path not taken toward genuine financial integration. The Tanzanian model suggests an alternative is technically possible. The ABF proves an African vehicle can exist. What remains absent is the political decision to match external financial architecture with internal institution building. That decision cannot be made in London. It can only be made in African capitals. The ETF launched this week is not an attack. It is an invitation. The terms of that invitation are set by those who issued it. African governments can accept the terms as written, or they can build something strong enough to set their own. The future of African financial sovereignty will not be determined by any single fund launch or currency summit. It will be determined by the cumulative choices of African states over the next decade, whether they deepen domestic debt markets or remain dependent on external issuance, whether they build regional payment systems or continue routing transactions through European correspondence, whether they capitalize their own institutions or wait for external actors to fill the gap. The ETF in London is now operational. The ECO deadline is approaching. The responses, or their absence, will reveal what African sovereignty means in practice. If this documentary added to your understanding of the financial architecture shaping Africa's choices, subscribe to the Sahel Lens. We examine African geopolitics through evidence, context, and original analysis. The goal is not to tell you what to think. It is to give you the tools to understand what is happening and why it matters. Thank you for watching.